1980, the US economy went into a recession.
It's clear that the true problems of our nation are much deeper than gasoline lines or energy shortages, deeper even than inflation or recession. And I realize more than ever that as president, I need your help.
You see, this line slightly points upwards, like in September 1977. But about a year later, it started pointing a little downwards. And then not long after that, bad news, recession hit the US. It happened again a few months later. The line curved downwards, then another recession in 1982. This happened again in 1988 and in 2000 and in 2008. This yield curve has predicted every recession in the past half century. And this is why some experts recently freaked out when this happened again in August 2019. So what is this line? This is related to the US Treasury bond. A bond is an agreement saying that if you lend the federal government $1,000, for example, they'll pay you interest while they hold on to your money until it matures. In simple words, the longer you let the government keep hold of your money, the higher the interest rate you earn, which means more money for you. Secondly, you also need to understand that most investors do not buy their bonds from the government directly. They buy and sell from the secondary markets, which means the prices of these bonds keeps changing based on the demand for these bonds, which also means the yield on these bonds keeps changing as well. So when we trace a line, we get a curved or a trend line showing the yields of different bonds, or what we call the yield curve, and this normally points upwards. Now here's where it gets complicated. Imagine you are an investor and you have a feel that an economic downturn is at your door. If your assessment is correct, that means you will get your return on your money after 2 years, but will have no opportunities to reinvest in. This makes a 2-year bond less attractive to you. And if a lot of people start thinking like you, the demand for 2-year bonds fades and they start selling their bonds in the secondary market for cheaper. But because the 2-year bond now costs less, it yields a better return relative to the low cost. And at the same time, investors who think a downturn is coming might think, I'd rather invest in a 10-year bond that pays out way later when I think the economic downturn will be over. And this increases the demand and also makes the 10-year bond expensive, so investors start yielding less money. And if more investors are acting on this expectation, the yield on a long-term bond, which is almost always higher than on a short-term bond, can actually dip lower and go in the other direction. It inverts. When this chart looks like this, investors think an economic downturn is coming. It's quite safe to conclude that whenever the yield curve inverts, it's not a good sign.